Let's go to Ken from San Diego.
Okay.
So Ken from San Diego, he goes, being considerably risk adverse, I'm curious about your opinions related to FIAs, which stand for fixed indexed annuities. Or some people call them equity indexed annuities. But I think the SEC or someone got upset and they said, no, you can't put the word equity into it.
Yeah, they used to be called EIAs, right?
EIAs,
I remember that acronym.
Specifically, the growth options where you just park cash and let it grow. I'm considering parking $1 million from my recently retired wife's 401k for about 5 years while I'm still working. I'm looking at a fund that will give a percentage bonus on the initial balance, but it's seeming a bit like too good to be true. I realize I have to pick the index and the upside is clipped, but appreciate your thoughts. Okay, Ken.
Wow, I'm just going to sit back and listen.
Well, this is how it's sold.
Yes.
All right.
It sounds great.
Okay, so all right, let's talk about it. It's a fixed annuity. So let's start there. Let's just start really basic. What a fixed annuity is that you are giving your dollars to an insurance company, and what you receive from that insurance company is a fixed rate of return. Fair enough?
Okay.
Like a CD, Al. You have CDs.
I do.
Most people don't know how this stuff works. So let's say you go to the bank and you want to purchase an FDIC insured CD. So you give U.S. Bank, whatever, $100,000. They're going to pay you 2%.
Right.
All right? What do they do with that $100,000? They're not putting it in the vault and waiting for you to come back in 6, 8 months or 12 months or whatever the term of your CD is. They're investing it.
Yeah, they're trying to make more than the 2% that they're paying you.
And they're making a lot more than that in most cases because they're
loaning money out for whatever.
Boats, right? A boat loan, car loan, credit cards.
A house loan. 4.5%.
Right? Credit cards, 24%.
Right.
A boat loan, 12%.
Right.
Right, whatever. So they're lending the money out, right? And so they're trying to reach higher than that 2%. That's called a spread.
Right.
And so when people hear that with the banks, they go, okay, yeah, that makes sense.
Right.
Insurance companies, when it comes to fixed annuities, do the exact same thing. But, they got a reserve. So you give your money to the big insurance company. They're going to give you a fixed rate of return. So I could buy a fixed annuity. The difference between a fixed annuity and a CD, in layman's terms, is that the interest on a CD that I receive is taxable each year that I receive it. In a fixed annuity, it grows tax deferred. So let's say I get a 5-year, 2% fixed annuity. That 2% on my principal, I'm not paying taxes on until I take the income out of the annuity.
Right.
Okay? Annuities also have special terms, or is that you have to be 59 and a half to get the money out, or there's a 10% penalty. Every interest is taxed at ordinary income rates. All right? Now, that's a fixed annuity. They're like, okay, well, that's great, but that's boring,
Yeah, that's. I want a better return.
I want something cooler.
I want something more like market returns.
Yes.
But I don't want to lose money.
Right. And so how it's sold and how it works are two different things. I'm not opposed to how it works as long as it's disclosed appropriately. But like right here, Ken, he's saying, I'm getting a bonus. So what he's getting himself into is a fixed indexed annuity. So it's a fixed annuity, and they're going to promise him a bonus. Give us $100,000, we'll give you 5% right up front.
Yeah,
no questions asked.
Got 105.
Yep, all of a sudden, $105,000. Or it could be even a bigger bonus. Maybe it's 10%.
Right. Now you got 110.
Now you got 110, 18%.
Day one.
We've seen that before, too.
We have.
18 grand right up front.
Yes, we have.
How do they do this?
Yeah.
This is great. It's like a free toaster when I go open up a checking account.
Right.
Expensive toaster.
Yes. So how the fixed indexed annuity works, and there's all sorts of different flavors. I have no idea, Ken, what you're buying. If you want to show me the contract, I'll be more than happy to, dive in a little bit deeper for you. Not me, but someone in my firm will.
Let's be clear.
Let's be clear. Is that you're buying into, how do I say this in layman? Oh, like a zero coupon bond. right, with a call option
Okay.
on whatever index that he chooses.
That's in layman's terms?
Kind of. That's why I had to think about it for a second. So, because let's say because on your fixed index annuity, it says, well, how about you can invest in the S&P 500? Or
Okay.
how about the Russell 2000?
Sure.
How about the Wilshire 5000? Oh, well, now I'm a stock market investor.
Right.
But I'm never going to lose money.
Yeah.
Because how it's sold is that you can get stock market-like returns with no downside risk.
Yeah.
Right? So if the stock market does 6%, you'll get 6%. The market does 8%, you'll get 8%. But if it goes down 20, you don't lose a dime.
Yeah. Now that sounds great.
That sounds perfect.
Yeah.
Who doesn't want that?
Yeah. Now what's the problem?
Of course, I mean, it doesn't work that way because you have to look at the fine print on these products. Most of them, they'll have a participation rate, okay? So let's say the market does 10%, but what is your participation in it? Maybe you only have a 50% participation. So now the market does 10%, but my participation is only 50%, so I'm getting 5. Then there's also caps with how much that you can make on maybe it's a point-to-point on a month-to-month basis or year-to-year basis or things like that. So you have to look at that. Maybe I can only get 2% per month on a 50% participation contract.
Right. And the market goes up in 1 month and it's flat
It goes
the rest
up,
of the year.
yeah, it goes up 8% in 1 month.
Right.
Well, I got a 50%, right? So that's 4 plus the cap on it. Well, it's 2. And you're like, well, what the hell? The market's up 10. I only got 2. Right. That's how the insurance companies make all the money.
Right.
Because you got a bunch of guys out there saying stock market-like returns with no downside risk. Oh, and by the way, I'm going to give you 10% up front to boot
Right.
and a free toaster. What do you think?
Where do I sign?
Yeah, because you get all these conservative investors that are now retired that they're looking at their statements because they need to live out this stuff. He's retiring in 5 years. And I like how Ken goes, well, I want to take my wife's money and put it in this thing. I'm not going to put my money into it.
Right. Sure.
So if they would say, would you like a fixed annuity that will probably tie you up into this product for 10 years, right? You have to look at, well, how long am I going to be in the contract? If they're giving me an upfront bonus, you know it's longer than 10 years in most cases.
Right.
Right? Maybe 7 to 15 years. So now I'm stuck in this product. Now I try to take the money out. I got huge surrender charges because they're lending that money out. The insurance companies are doing all sorts of stuff with it.
Now you can take 10%.
Oh, yeah,
per
that's
year.
what the brokers are telling them or the
Right.
insurance agents. Well,
Yeah.
why would you want to take it all out? Come on, Ken.
This is a great
you only
investment.
want to take 4% out per year, don't you know? The
Right.
4% rule?
Right.
Why are you taking out 10? You know, we'll give you 10. So there's a lot of really bad sales practices behind it. But if it was like, okay, here's my commission, you give me, he's going to get $1 million, all right? Guarantee the commission on that product at a bare minimum is what?
I was going to say 70 to 100,000.
It could very easily.
I don't know what a minimum is, but that's what I've seen.
You know what, right?
Yeah, 7 to 10%. It could. We've seen higher.
Right. So you got 10%. I'm going to put $1 million. You're paying the commission on that is $100,000.
Yeah,
We've seen a little bit higher than that.
we have.
Right. 18% commissions we've seen. We try to go help this guy comes in 90 some years old or 87 years old, right?
He's in his mid 80s. Yeah.
Mid 80s, couple $1 million in like 7 different contracts. And I was like, well, why do you have all these? Well, it's diversification. No, bull. It's all different, right? Break points and stuff like that.
And every contract was 17 years.
Yes, and he went to different. This broker went to like different types of because one insurance company is going to be like, you're putting this gentleman's entire net worth in this annuity. This is illegal, sir.
And he's
That's why he's like breaking it up and he's putting it all over the place.
Right.
I mean, there's a lot of crooked out there.
It out
right?
there. Yeah. Right.
Yes.
Okay. Got it. Anyway, so what's the advice? I guess just be really careful. Know what you're getting into.
Yeah, because you're right. If it sounds too good to be true, Ken, what do you think? It is. If you want the skinny and just say, okay, I'm willing to tie up my money for anywhere from, let's say, 10 to or let's say 7 to 14 years. I don't know what contract he's getting sold here, right? It's $1 million, or maybe it could be annual liquidity. If that's the case, well, then that's a totally different story. Maybe there's no commission in the overall FIA, but if there's a bonus involved, and there's
we gotta believe.
I'm guessing. I'm just guessing.
It's a pretty good hunch. I would agree with you.
So without me knowing anything about what product that you're thinking about going into, that was kind of with a broad brush.
Sure.
Just buyer beware. Think about, the pros and cons of everything, because it sounds to me that he only knows the pros.
Right.
Ken does not necessarily know
Well,
the
he
cons.
knows the upside is clipped. He is aware of that.
And he knows that it sounds too good to be true.
True.
I realize I have to pick the index and upside is clipped, but here's how it's sold. If the market does 12, I could get you 11. What do you think?
That sounds pretty good.
So we can't get you the full upside of the market, but almost. So I don't know. Hopefully that helps, Ken. But if you're a conservative investor and you want, but to be honest with you, we've seen just straight fixed annuities perform better than some of these indexed annuities or fixed indexed annuities. It depends on, again, participation rate, your points, and caps and all that other stuff. So let's see. Ross from Los Angeles, he writes in too in same type of question that we did from Ken.
Okay.
He goes, boys, I need your intelligent thoughts. What do you think of a fixed annuity within your IRA that pays an average of 3 to 6% with no loss ever, and a cap of 10% when market does well, no fees? Really value your opinion, since it appears so many financial advisors don't like annuities. Okay, well, this is just another way to explain what we just went through in the last segment. So, on average, 3 to 6%.
Which means 3.2.
Well, look at this, Alan. If I'm looking at the expected rate of return, let's say if Ross here, if I let me put my little Larry Spudgero hat on.
Okay.
Right.
Can you talk like Larry?
Hello. Hold on a second. I gotta shut the door. The dogs.
Dog.
The
Get the
dogs.
dog out.
It's
Every time we call him, that's what we get.
Oh, I love Larry.
It's wonderful.
And but if you think about it, so he's getting sold this now. All right, average 3 to 6% in a fixed annuity, averaging 3 or 6%. Come on, we're at interest rates right now. What's a 10-year Treasury at?
It's
2?
two and change.
Okay, so of course the insurance companies are going to pay you 3 to 6, and it depends on what index he selects, because it's like, well, when the market does well, what market are you referring to, Ross? Is it the S&P 500? Is it the Russell 2000? Is it the international? Is it the there's so many different types of indexes, but let's just assume he's going to select the S&P, right? S&P price earnings ratio is pretty high. If you look at the earnings yield on that, right, the future expected return of the S&P is probably around 3%.
It's lower than usual because it's so high right now.
Right. So when you have prices are high, your expected returns are going to be lower.
Yeah, and I think a lot of people don't understand that. When prices are low, future expected returns are higher.
Right.
It's kind of almost the opposite of what you might think.
So he's saying 3 to 6%. I would find if that were the case, if you could get on average 3 to 6% with zero loss,
yeah,
and a cap of 10, why the hell wouldn't you?
Yeah, it sounds great.
I would do it, but it's not true. It's not going to happen. It's just I just don't think that. It's not like financial advisors don't like annuities, right? Financial advisors that are fee-only fiduciaries don't like how annuities are sold. If they said, all right, here's a fixed product that you're stuck in, and here's how it works, right? And you're probably going to get what's a fixed annuity? I mean, can we look it up on, fixedannuity.com or something like that?
What are they paying now?
What's a standard fixed annuity paying? I would guess, 2.5? 3?
Well, no. Well, they don't say it that way.
No. This is a fixed indexed annuity. I'm just saying if I wanted to buy a straight fixed annuity.
No, but I'm saying, but they talk about it in distribution rate, which is also getting your own money back.
Yeah.
That's where I'm going.
Oh, no, that's an immediate annuity.
Right. So that might be 4% or even 5.
7.
But they're giving you your own money
Principal back.
Right.
Right. So I would just, if that was the case, Ross, then yeah, by all means. But I just don't think you can average over the next, let's say, 10 years, 3 to 6% in a fixed annuity. Why would they cap it? So the cap's at 10. So if the market does 9, a market does 11, you get 10. Again, you gotta always look at the fine print.
Yeah. So we don't know the details here, but wouldn't it be safe to say, Joe, that we've looked at a lot of these, and have you found one that you would recommend?
A fixed indexed annuity?
Yeah.
No.
Ever.
There's things that I hear. It's like, okay, well, here there's no surrender charges. And they say no fees. It's BS.
There's lots of fees.
It's not a fee. It's something else. It's called a spread. Right? It's different. It's just different terminology. They're making a ton of money. You're not getting any dividends from the stocks because they're buying options on the stuff. And it's not like a per se fee that you see. It's a spread and there's commission. It's just word games.